Introduction. An option trading is an entirely different animal as compared to standard stock market investing. Let's think for a moment about the conventional wisdom that is dispensed about stock market investing. The general idea is to buy and hold, keeping your investments for a very long period of time. Basically, you're expected to keep your investments until retirement. People do various strategies, such as rebalancing their portfolio to match their goals, diversification and dollar cost averaging. An option trading is a totally different way of looking at things. First of all, even if you're a day trader or engaging in activities like swing trading, the general goal, when it comes to stocks, is to buy when the price is at a relatively low point and then sell at a high price. In reality, the day trader, the swing trader, and the buy and hold investor are no different. Buy and hold investors think that they are unique and above everyone else. They are, in reality, just trying to make money off the stock market too. The only real difference, unless you're a dividend investor, is the time frame involved. So, a buy and hold investor can hold the stocks for 25 years, and when they are going to start cashing them out for money, meanwhile, a swing trader makes money in the here and now. So in that sense, an option trading is more like swing trading. And in fact, in many cases, you're looking for the same price swings that the swing trader seeks. But as we've seen, options allow many strategies that are not available for any type of stock market investor. I suppose that in theory, you could buy huge numbers of shares of a stock and try to set up similar arrangements, but it just wouldn't work. And besides that, even if it did, it would require an enormous amount of capital. The point of this discussion is to lay out the groundwork and acknowledge that most of us come to options with a completely different mindset. So it does take some getting used to, and many beginning options traders are going to make mistakes. That's just the nature of the market because it's so different than what people are used to. There isn't really a comprehensive list, however. I picked out the mistakes that I've noticed most people make. Going into a trade too big. One of the mistakes people make when they start out options trading is making their positions too big. Since our options don't cost all that much relative to the price for stocks, people aren't used to trading in smaller amounts. Even people who are not rich or anything, thinking in terms of the stock price and how much 100 shares would cost. This can set up people in trouble. The temptation is going to be there to move on a large number of contracts when you start making your trades if you have the capital to purchase or sell them. This can actually get people into trouble. It's not really the dollar amount that is a concern, but it could get you in a position where you're not effectively ready to act as quickly as you might need to, depending on the situation. So, if you find a trade and decide to sell 20 contracts if the trade goes south, trying to buy back those 20 contracts might be problematic. Or you might end up buying a bunch of call options and have trouble getting out of them on the same day. It's indeed better to have a few different smaller positions with the options than it is to have multiple positions when they are large numbers. Remember that options prices move fast. You don't want to over-leverage your trades and be in a position where you can't find a buyer to pick up all 10 or 20 contracts. Not paying attention to expiration. This is probably one of the most common mistakes made by beginning traders. The expiration date is one of the most important factors that should be considered as you enter your trades. And once you've entered a trade, you need to have the expiration date of the options tattooed on your forehead. This is something that is not amenable to being ignored. First of all, choosing the expiration date when entering the position is just as important as picking the strike price of the option. But one of the things that beginners do is to focus too much on the price of the option and the price setting for the strike. The cost of the option and the strike price is obviously very important, and the expiration date is important as well. Unfortunately, far too many newbie traders ignore the expiration date when their trades are not working out, and so they end up just letting the option expire. Of course, when that happens, if it's out of the money, you are totally out of luck. It is just going to be at 100% loss. So we need to be paying attention to expiration dates before we enter the trade. And we also need to pay attention to expiration dates when we are managing the trade. Buying cheap options. There is a saying that says you get what you pay for. There are reasons to buy out of the money options sometimes, but you shouldn't go too far out of the money. Unfortunately, many newbie traders are tempted to go far out of the money for the sake of buying a low-priced option. The problem with these options is that even though out-of-the-money options can make profits if they are too far out of the money, they simply aren't going to see any action. So there's no sense buying a cheap option just because you can pick it up for $25. You don't want to be sinking your money into options where a massive price move would be necessary in order to earn any profits. It's fine to buy options that are near the money. Options that are close to being in the money can be very profitable even though they are out of the money. So if you're looking to save a little bit of money when starting your investment, that is always something to consider. But to make profit, the basic rule is that there has to be some reasonable chance that the stock prices are going to move enough in order to make the option you purchase going the money. Failing to close when selling options. If you want to remember just one thing from our discussion about selling options, whether it's selling put credit spreads or naked puts, you should keep in mind that it is always possible to exit the trade. The way you exit the trade when you sell to open is to buy to close. You want to be careful about doing this because it's too easy to give in to your emotions and panic and prematurely exit a trade. However, you need to be aware at all times about the possibility of needing to close the trade. Riding out an option all the way to expiration is a foolish move unless it is evident that it is going to expire out of the money. As a part of this problem, new options traders often come to the market and focus on hope as a strategy. When it comes to investing, hope is definitely not a strategy. Hope is something that belongs to a casino playing slot machine games. When you're trading options, you should make as rational a decision as you can, depending on the circumstance. So, when the expiration date is closing, and it is clear that the trade is not going to be profitable, don't give in to the temptation to think of waiting around for a reversal in direction. When you think of something like that, it opens up the temptation to stay in the trade far too long. At some point, you might not be able to recover at all. Therefore, what you don't want to do, and this is true for buying and selling, is hoping that there's going to be a turnaround and waiting to see what happens. For those who are buying options to open their positions, this is the worst of all possible strategies. Remember that when you buy to open a position, time decay is working against you at all times. Hence, unless the stock is moving in the right direction, there isn't a reason to hold the option. For sellers, time decay actually works in your favor. But there can be situations when it's just smart to get out of the trade. Let's look at a couple of examples. If you sell to open an iron condor, and for some reason the stock has a breakout in one direction or the other, it's better to get out of the iron condor immediately. We aren't talking about a $1 or $2 change. If the stock goes in such a direction that one of your options goes in the money by a small amount, that type of trade is worth waiting out to see what happens. But if there is a big break to the upside or the downside, it would be foolish to stay in such trade. For one thing, you'll be at risk of assignment, but the most likely situation is that you're just going to lose the maximum amount of money. But if you have a good strategy and only get involved with options that have a high level of open interest, almost no matter what the situation is, you should be able to buy and sell that option quickly. The other obvious example is if you are selling a put credit spread already naked put, but you notice that the share price is declining right towards your strike price. You don't have to panic right away. Remember that in order for exercising the option to be worthwhile, the share price has to move enough so that not only does the option go in the money, but the price move also accounts for the money that was paid for the premium to buy the contract. Therefore, if you have a strike price of $100 and someone paid $2 to buy the option, if the share price is $99, they are going to exercise the option. Even if it drops to $98, they still might not exercise the option, unless there were some factors that indicate that the stock was about to turn around so they can sell it at a profit. But that's an unlikely scenario. It's only when it starts going strong, then there's a problem. Chapter 1. Options Basics. According to the rules governing options trading, Whoever takes a purchase option on a house has not yet bought that house, but has the option, the right to buy the house within a certain period. In the financial markets, they pay an amount for an option to the person granting the right, the so-called option premium. You cannot buy without a seller, so there are always two parties involved. The profited one is therefore losing another. We call this a zero-sum game. However, both the buyer and the seller can both earn money if the seller holds shares to cover the options. The profit on the shares then compensates for losing this option. Call and put. Call. A call has a right to an underlying buy at a convincing price within a certain period. Sell. A sell is a right to an underlying asset to sell at a specific price within a certain period. If you have a right, you can exercise it. If you have a duty, you are in a dependent position, and if you have to wait for the counterparty to exercise its right. To acquire the privilege of the underlying, the buyer has to pay a premium to the seller, writer. Remember, before entering a duty, you want a consideration, a payment or a premium in money. Options are a standardized product, so everyone can trade them at the same time on equal terms. For example, the same specifications apply to your neighbour with the same option as you, although the cost per broker can differ. Options can be applied both defensively and offensively, depending on the objective of an investor. A defensive investor will use options differently than an offensive trader. It is precisely that aspect that makes options a product that deserves a place in every investment portfolio. There are also many options because of the combination of options, which you only have with options and not with shares. Options are the best invention after the wheel. Just like with a wheel, you can also roll options to a later expiry date. First, realize that during the entire term, you can either buy or sell options during the whole term, so you don't have to wait until the last trading day. Buy and sell call options. The big difference between buying or selling options is that you buy a premium when you buy options, and you receive a premium when you write. So there is a risk that the counterparty, or buyer, can exercise his option if the expiration option has value. Long call. Buy a call. You can compare buying a call option with an option on a house. You may, but do not have to, buy a house, for example, €350,000 within a certain period. Suppose the house increases in value to €400,000. You can exercise your purchase right, and you have a profit of €50,000. In options trading, unlike a house, an option is not free, but the buyer must pay the price, the option premium, to the agent of the option. Notice how the graph line increases up the theoretical PL axis as basic aid increases in price, illustrating that this position benefits from an increase in the price of the basic aid. The graph above shows a call option on option ABC with an exercise price of $10, for which $1 has been paid. The more the share rises, the higher the premium of the call and therefore the profit. The break-even rate, the price where neither profit nor loss is made, is $10 plus 41 equals $11. Loss is limited to the determined option premium of $1. This is times 100 because the option relates to the elemental amount of 100 shares. So here it is, $1 times 100. Even if the stock drops to 1 cent, you can never lose more than the paid option premium of $100. Imagine the option quotes $15.88. The call is therefore at least worth $5.88 because the net asset value is 15.88 to 10, which equals $5.88. The profit in this case is 5.88 minus 1, which equals $4.88, a profit of 488%. Short call. Sell a call. The seller of a call option has an obligation, but not the right, to deliver a fixed amount of an underlying asset at a predetermined price, the exercise price. Sellers calling an option can best be compared with an insurer who speculates on the do not pass a certain event, an underlying rise above a certain price. In the short call position chart, it shows the limited reward as the position graph line levels out just above the break-even line. It shows the risk increasing to an unlimited amount as the underlying asset price increases. The graph of a short call is therefore the reverse of the long call of the example mentioned above. The profit is limited to the $1 received. The selling call option diminishes as soon as the option exceeds $11. The loss of a rate of $13 then amounts to $2 times 100, which is $200 on expiration. Although the option is worth $3, the premium received $1, which can be deducted from this. When trading in call options, there are the following order options: open buy call, opening order of a purchase call option, opening long position; close sell call, closing order of a purchase call option, closing long position; open sell call, opening order of a sell call option, opening short position; close buy call, closing order of a sell call option, closing short position. Purchasing and vending put options. I explained everything about the difference between buying and writing call options. In this part, I will discuss the difference between buying and writing put options. The client of the option put has the right, but not the obligation, to a fixed quantity of the underlying asset to sell at a predetermined price and within a specified period. This illustrates that this position benefits from a decrease in the price of the underlying asset. Long put. Buy a put. You can compare a put with an insurance policy for a house. You can insure your house for example, $350,000 within a certain period. Suppose your house drops in value to $300,000. You can exercise your sales right and you have a profit of $50,000. In the option trade, an option is not free, but the buyer of this insurance must pay the price, the option premium. The special thing about this insurance through options is that it is unnecessary to have the underlying asset, but you can purchase the insurance separately. Compare it with that you want to insure someone else's house against a fall in value. The graph above shows a put displayed on the ABC option with an exercise price of €10, they have paid for which €1. The lower the share goes, the higher the premium of the put and therefore the profit. The break-even rate in this case is $10 minus $1 equals $9. It limits the loss to the paid option premium of $1. This is times 100 because the option relates to the underlying value of 100 ABC options. So here it is, $1 times 100. Even if the price of the option rises to $50, you can never lose more than the paid option premium of $100 if ABC quotes $5.88. The long put is then worth at least $4.12 because the net asset value is $10 minus $5.88, which equals $4.12. The profit is therefore $4.12 minus $1 equals $3.12, a profit of 312%. Short put, sell a put. The seller, writer of a put, has a responsibility but not the right to purchase, buy, a set amount of an underlying asset at a predetermined price, the exercise price. In the short put position chart, the limited reward is shown levelling out. It shows the risk increasing to an unlimited amount as the underlying asset price decreases. You usually first have to own something to sell it, but with options it is not. For most people, this is weird and requires an alternative way of thinking to understand how that works. How can you sell something that you don't have or go short? This is possible with options, but there is something in return. An obligation to supply or purchase realize that this is not the same as buying a call. To better understand this, you can again use the fire insurance example, but now you are the other side, so the insurer. You offer insurance, and you now receive a premium from the person who takes out the insurance with you, but there is a consideration in return. You can sell an option, and you will receive money for it. You can compare sellers of put options with an insurer speculating on the non-occurrence of a certain event, an underlying value that does not fall below a certain price. The counterparty, the buyer of the put, pays a premium for this insurance to the seller, writer. You don't get that money just like that. That would be a bit too good. There are certain risks involved. As a seller, writer of a put, you have an obligation to purchase the underlying value if it falls below the exercise price. Your bank, broker, will not just allow you to take on these risks. This is only possible if you have a sufficient margin, deposit. Let us clarify this with the example of a selling put option on an option. Suppose they list these shares at $10. The put option that gives you the obligation to buy these shares in 6 months at $10 now yields $1 per share. The counterparty has the right to sell the shares, but you must purchase these shares at $10 if the buyer of the put so wishes. To sell the option securely, you must already set aside enough money in your account to meet your obligation in 6 months. You need $10 minus the premium received of $1 per share if the buyer exercises this option. You need to take a few risks with this money because you must always remember you must purchase these shares at $10. For each sold option, that is, 100 ABC shares. If the price drops to $7.50, you will suffer a loss of $2.50 minus $1 for every sold put. So that means $1.50 times 100, as you can see in the graph above. You can also choose to close the option early, so you no longer have the purchase obligation. Another possibility is to roll the written put option to another expiration date. Chapter 2. Proper Risk Management. Proper control of the money and exposure towards risk is important when selling options. Whilst also risk for any type of financing is essentially inevitable, your perceived risk needn't have to be an issue. The aim is to properly handle risk funds. Also guarantee that you must be happy with the number of risks being faced and you're not vulnerable to excessive losses. You can apply the same notions also in maintaining your money. You must use funds to trading which you may afford to damages. Avoid too much stretching. Since an effective way to assess money is totally crucial for successful trading options, it is a topic that you'll want to comprehend. Here we take a glance at a few of the techniques which you can and need to use to manage your overall risk and control your budget. Utilization of options trading blueprint. Getting a comprehensive trading strategy that sets out the rules and criteria for your trading practices is quite necessary. One of the useful applications of this plan is to help work for your money and attention to the risk. Your strategy will provide descriptions of how confident you are with the amount of danger and how much money you must use. By implementing your plan and using only the funds you have allocated for trading options, you could even avoid a few of the major blunders traders and investors make utilizing petrified money. You're much less inclined to make good choices about your trades as you deal with capital that you can't afford to waste or would have put aside for many other purposes. Although it is impossible to eliminate the sentiment inherent with selling options entirely, you just want to be more focused on what you're doing and why. When fear takes hold, you will actually lose control and act irrationally. For instance, it could lead you to pursue gains from past trades that have gone wrong or make purchases you would also not usually do. You will have a lot stronger chance at holding your feelings in check if you obey your strategy and stick to managing your financial money. Similarly, you also should stick to the standards of danger that you specify in your strategy. If people prefer to do low-risk trading, then there's no explanation why you might start revealing yourself to greater risk levels. It can often be enticing to do all this, maybe, even though you've made a couple of damages and would like to try to fix them. But maybe you've done well with other low-risk transactions and want to continually increase the earnings at a rapid rate. Even so, if you schedule to do low-risk transactions, then you clearly did for a purpose, and for the same empathy mentioned reasons above, there isn't a point taking oneself from your own will. Unless you found it hard to manage the risk, or suffer to know when to evaluate the level related to a specific trade, following may be useful. Knowing risk charts and risk-to-price ratio. Below are some of the strategies that could be used to mitigate risk while selling options. Risk management with spreads options trading. Split options are valuable and efficient methods for trading options. A spread of options is essentially where you merge and over one position on contract options, depending on the very same underlying protection to ultimately establish a single overall trading role. For instance, if you purchase a specific stock throughout the financial calls and then did write the lower cost on the same stock OTM calls, then you'd have formed a spread recognized as a bull call distributed. Purchasing the calls implies you're gaining if an underlying asset increases in value, but you'd lose all or some of the money you've spent buying it if the share price didn't go up. You would have been capable of controlling a few of the upfront costs by having written calls to the same stock and thus decrease the majority of the money that you could end up losing. All strategies for trading options entail the use of flows, so these flows are such a helpful way of managing risk. People could even need them to decrease the initial costs of joining a position, as well as reduce what money you are to lose, as in the example cited above for the bull call distributed. That means you're theoretically growing the income you'd create, but it decreases the total risk. Spreads can often be used to lower the danger when reaching a limited spot. For instance, if you write in the money that goes on a stock and you will obtain an initial payout for writing certain options, but if the stock fell in value, you will be vulnerable to possible risk. If you've also purchased better value for money OTM puts, you'd have had to invest a few of the initial fee, but you'd cap any possible losses which a share decline might cause. This specific spread pattern is called as spreading bull put. As you'll see in either of these illustrations, if the market reaches the correct way for oneself, you can join positions and you still expect to benefit. But if the market reaches against you, you could even severely restrict any losses which you might inflict. That's why traders utilize spreads so extensively. They seem to be outstanding risk assessment devices. There's still a wide variety of spreads that are used to manipulate almost every business environment. We also included a collection of all options spreads, including information about how and where they are used in the trading techniques. You might just want to link to this segment when preparing trades with your shares. Risk management with diversification of options trading. Diversifying is a method in risk control usually employed for investors who employ a buy and sell approach to construct a portfolio of securities. To these funds, the fundamental concept of diversifying is that dividing capital through various firms and markets produces a flexible account instead of making so much money locked up in a single company or industry. A diversified fund is usually deemed less vulnerable to risk than a fund entirely made up of one in particular type of financing. Diversifying is not necessary in the same manner whenever it applies to options, but it also has its applications, and you can potentially diversify in various ways. While the concept remained relatively the same, people don't have too much of your wealth willing to commit to one particular type of financing. Diversity is used by a range of ways in trading options. To use a range of different methods, options trading based on the different trading assets and the different trading option types, you could even diversify. Basically, the idea to use diversity is that people expect to make earnings in a variety of ways and that you are not totally dependent on each specific result to be successful in all of your trades. Risk management by utilizing options trading orders. A fairly easy method of mitigating danger is to make use of the number of various orders you may position. There is a range of different instructions that you can put in addition to the 4 key order forms that you use to open and close rolls, and all of them will assist you with risk control. For example, at the moment of execution, a standard market order shall be filled out at the best possible price. That is a completely natural way to sell and buy options, but the order can end up filling up in a competitive market at a higher price level or lower than you expect it to be. You can prevent purchasing or sell at less desirable rates by utilizing limit orders, where you can specify minimum and maximum costs for which the order will be filled in. Also, there are orders which you could use to optimize exiting a stance, whether to bolt already made revenue or to reduce losses on an exchange that has not worked well. You can easily monitor to what stage you exit a place by utilizing commands such as the maximum stop order, the business stop order, and the following stop order. This will help you to avoid scenarios in which you miss out on profits by holding over to a place for much longer, or inflict large losses for not closing off on a poor spot fast enough. By appropriately using orders, you can minimize the risk to which you are subjected to each trade you do. Managing money in options trading. Seek not to get too emotional over wins or frustrated by losses to be effective in trading. Investing capital depending on gut instinct or word of mouth is a really bad way of investing. In all situations, a lack of rational reasoning contributes to one thinking the exchange would thrive. Greed has probably cost more to the market than fear. When an exchange is carried out on the grounds of expectation, it is fundamentally irrational and may result in quick actions made on bad judgment. They also find it really hard to reduce their losses whenever a market moves against such an entity. They can get deeply connected to trade and keep hoping for a change in trend. Given the economic, technological and emotional factors that indicate it should be wise to take out significant returns, several people wanted to ride their market drop from the high in 2000. You should set targets and concentrate on what you've been doing to meet those goals. Set clear expectations on what you plan to do over the next 3 months, 6 months, or years. After that, you will create targets for the long run. By trying to write down your thoughts, you will get a clearer picture of what you'd like to achieve. You'll focus on advancing the understanding, centralizing everything you've discovered, and reviewing the evidence before and during the exchange. That would offer you a big benefit over the average investor who's really spending more on the basis of sentiment than truth. The art of creating money will follow naturally. When a person focuses on being the finest in their career, the money will flow seamlessly through them. Likewise, to be a good trader, instead of concentrating on the capital, you must focus on dealing properly. To get the max rewards and risks that incur, you must have defined endpoints. Your methodology should be well organized and systematic. You would be able to witness by this technique why your transactions were financially beneficial. By knowing the performance approach, you'll find the keys to continuing achievements because you'll be likely to duplicate the cycle again and again and continue to increase your market size and net value. Chapter 3. Sector Analysis, Technical and Fundamental. The basic principles of technical analysis. To better understand the technical analysis, we will summarize its fundamental principles. We will show the importance of the psychological dimension of technical analysis. Fundamental principles. Based on the work of renowned technical analyst John Murphy, we will present the main properties of technical analysis. Technical analysis focuses on what is rather than what should be. It is interested in the market itself and not the external factors that it reflects or that may have influenced it. It describes market movements, not the reasons behind it. This method focuses on the psychology of the operators and not on the fundamentals. Indeed, what matters is not the news, but the way operators react to it. This is a strategic approach to the stock market and not a fundamental approach, whose main purpose is the search for the intrinsic value of the asset. The technical analysis does not question the concept of fundamental value, but argues that there may be lasting divergences between the stock price and the latter. The market value is entirely and solely determined by the game of supply and demand. Supply and demand depends on many factors, some of which are rational and some not. The market results from the permanent interaction of all these behaviors and the differences in interpretation of the speakers. Fundamentals are just one price determinant among many others. The courses evolve according to trends that can last a certain time. The trend changes are due to a change in the dominant consensus that will change the balance of power between suppliers and applicants. The graphs consider all the information available at a given moment. History repeats itself, and markets are governed by the psychology of crowds. The phenomena of euphoria and panic are very often found in the markets, and this cyclically. The following sentence, attributed to the famous speculator Jesse Livermore, sums up perfectly these words. "I learned early on that there was nothing new on Wall Street. Indeed, speculation is as old as the hills. What is happening today in the markets has happened in the past and will happen again in the future." These basic principles are favoured by many leading operators, analysts, traders. Consideration of the psychological dimension. Fundamental analysis focuses on the real value of a financial asset, but neglected psychological components, determining for the proponents of the behavioural approach. This approach has shown that psychological biases explain price shifts in relation to the fundamental value. Technical analysis, therefore, takes into account the psychological dimension and focuses on the emotions of operators. The fundamentals are supposed to be known to all, and the technical analyst's main task is to determine how the operators react to economic news. Basic information, growth rate, inflation rate, unemployment rate, contracts signed by a company, etc., has a significant impact on stock prices, but most professional traders attach importance even greater at the behavioural reaction of traders. Finally, as we have seen above, history repeats itself, and in financial markets governed by crowd psychology, it is common to note that the phenomena of euphoria are followed by panic movements. In a reference book, Gerald Loeb explains that a stock market price is only partly determined by a balance sheet and an income statement. It is much more by the hopes and fears of humanity, by greed, ambition, events beyond the reach of humanity such as natural disasters, inventions, stress, and tensions in the financial world, time, discoveries, fashion, and innumerable causes that it is impossible to enumerate. The famous American financier Bernard Baruch is going in the same direction as he explains, "Fluctuations in the stock market do not correspond to the recording of events as such, but to human reactions to these events, or how millions of men and women feel the potential impact of these events in the future. In other words, the stock market is a reflection of individuals." Technical analysis also helps to make a strategic approach, capitalizing on the emotions of other traders. The great economist Keynes was also a great speculator. In his financial operations, he relied heavily on crowd psychology and put aside basic analysis, which may seem surprising to a person who has had such a strong impact on economic theory. In fact, we owe him the following sentence: "There is nothing more irrational than investing rationally in the markets." This sentence does not mean that the investor must be irrational, but rather that the use of analytical tools considered rational must be used vigilantly. In his General Theory of Employment, Interest and Money, published in 1936, John Maynard Keynes describes the markets as follows: "Most professional investors and speculators are less concerned with making accurate forecasts in the long run than with predicting the future changes to the conventional valuation base shortly before the general public. In effect, the unacknowledged object of enlightened investment is to steal the departure, as Americans say so well, to be smarter than the public, and to pass the wrong or belittled piece to the neighbour." Technical analysis assumes that all the necessary information to the decision is contained in stock prices. The graphs represent a good barometer of investor psychology. Indeed, the technical analysis considers that it is the operators who are at the origin of the stock market fluctuations, and not the economic and financial news. If a stock goes up, it is that there are simply more buyers, only sellers. Conversely, if a stock is down, it means that the sellers are in surplus and plummet the stock prices. If this view of market fluctuations is also shared by fundamental analysis, the two methods diverge on the determinants of stock prices. For the fundamental analysis, the officers and the plaintiffs focus essentially on the real value of the security. Security will be asked if it is undervalued, priced below its fundamental value, and conversely, it will be offered when the stock price is higher than its intrinsic value. Investors are rational and position themselves solely on the basis of the fundamental value of the security. For technical analysis, the concept of fundamental value is not necessarily called into question. However, the security can fluctuate quite a bit before returning to its fundamental value. In addition, technical analysts consider it difficult to gather all the information needed to perform a fundamental analysis worthy of the name. It is for this reason that technical analysts seek, first of all, to identify the forces involved in order to determine the probable evolution of prices. The technical analysis simply seeks to answer the following question: which bull or bear will win the fight? The reality is that behind every offer or each application, there are many explanatory factors of fundamental and psychological. The theory of conventions explains that it may be rational to include it in its analysis factors that have no connection with fundamentals, such as fashion phenomena, for example. The stock price results from the permanent interaction of all these behaviours, and the fundamentals are only one price determinant among all the others. The prices evolve according to tendencies, which can last a certain time, because of the existence of a dominant convention. A change of trend can be explained in different ways. The fragility of the convention is updated by the financial community, which turns away quickly from the financial asset, example of the technological values. The players have positioned themselves massively for the purchase and cannot therefore more support the market. Any bad news will have a massive effect and will cause massive sales related to the panic of operators. Some technical analysts consider that there is no contradiction with the assumption of market efficiency, since the graphs take into account all the information available at a given moment. Nevertheless, they forget that fundamental analysis considers operators to be rational, which is not the case for technical analysis. Market movements are predictable because the stakeholders regularly make the same mistakes and systematically deviate from this state of rationality. Technical analysis is not a crystal ball. Technical analysis is a method that can predict the evolution of prices with some reliability, even if it is not an exact science. This pragmatic method focuses primarily on the psychology of operators. It was developed by people operating in the financial markets: Charles Dow, Gann, Homme, Schebacker, and others. The technical analysis serves mainly as a market barometer and can detect excessive movements of crowds. Some of its detractors equate it with a crystal ball, whereas it is simply an effective tool for analysing market movements. There is no such thing as a martingale on the financial markets, that is, an infallible system that makes it possible to win every time. First of all, the only martingale is the result of hard work, iron discipline, and the courage to stand up even when events are unfavourable. Operators generally have imperfect knowledge of technical analysis. In addition, it should be noted that the mastery of this approach is insufficient to succeed in the markets. Indeed, it is not enough to correctly predict the evolution of stock prices to beat the markets. The trader must also develop certain qualities that have nothing to do with his analytical know-how. Independence of mind, absence of ego, self-control, acceptance of uncertainty and risk. The reasons for the current success of technical analysis. Technical analysis is now more and more popular. We will list some explanatory elements of this current success. The limits of fundamental analysis. First of all, part of the success of technical analysis can be explained by the somewhat dull assessment of the fundamental analysis. This approach has been strongly criticised in recent years due not only to the bad or even misleading recommendations of financial analysts, but also because of the numerous financial scandals. Laura Unger, president of the SEC 13 in 2000, in a report showed that 99% of the recommendations of the 28,000 US financial analysts were to buy or keep securities in March 2000. In addition, some stars of financial analysis did not stop their buying recommendations, despite the market downturn. This has been very misinterpreted by individual investors and has given rise to numerous lawsuits. Henry Blodgett, an analyst at Merrill Lynch, waited until August of 2000 to lower his rating on eToys Inc. and Pets.com Inc., which he recommended for buying when they had already lost more than 75% of their value. Mary Meeker, a senior analyst at Morgan Stanley, gained tremendous notoriety by issuing a very positive report on internet values in 1995. After March 2000, she remained on the purchase and the titles she advised, including Priceline.com and Drugstore.com, literally collapsed. Even after assuming that fundamental analysis has a predictive quality, the many financial scandals have shown that it is very difficult for an investor, whether individual or professional, to obtain complete and reliable information on the fundamental value of a security operated by insider operators taking advantage of their privileged position. Chapter 4. The steps needed to start trading options. Now that we know a little bit more about trading options, it is time to take a look at some of the steps that you should take in order to get started. Jumping into the market may seem like a big deal, and you may be uncertain of the right steps that will make this happen. Some of the steps that are needed to start your options trading journey will include: pick out the capital. When you are ready to enter your trade, you will need to have a set amount of capital ready to invest. You could trade on the margin, which is where the broker will lend you some money so you can make bigger trades, but this is incredibly risky in options trading, and as a beginner, it is not recommended for you to do this at all. The best bet, to ensure that you are going to make smart trading decisions without increasing your risks, is to just use your own money for each trade. Before you start trading, and while you are researching, consider setting up a savings account and adding a little money to it each month. Then use this money for your trades. This way, you know exactly how much you must spend, and you aren't guessing or trying to come up with money that you don't have later when your trade doesn't turn out the way that you wanted. Your broker will require that you add the money to the account when you are ready to start trading, so make sure it is ready to go. You can also add some extra to the account to start so that it is ready to go any time that you see a potentially good trade that you want to get in on. Once you earn some profits, you can then withdraw them into another account of your choice. Choose a broker. One of the most important decisions you are going to make when you first get started with options trading is picking out a broker. This will determine the types of securities you can trade. For example, many brokers aren't going to work with cryptocurrencies for trading, how much you pay for each of your trades, and what kind of platform you get to use. Picking out a reputable broker, someone who is easy to work with, can make a big difference in the results you can get with your trades. The biggest thing to consider when you work with a broker, after determining that they do trade in the securities you are interested in, is their compensation plan. You want to check this out to see if it is going to be beneficial to you and your trading method. Since an option trading requires a lot of small transactions during the day, you don't want to end with a compensation plan where the broker gets a set fee every time you execute a trade. There are a lot of different fee structures that your broker can choose, and you need to learn and agree to the one that makes the most sense to you. Going with a set fee for the whole year would be ideal, but you can also work it out that you pay a percentage of your earnings, so if you don't earn anything on a trade, you won't be missing out. No matter which broker you decide to go with though, make sure to discuss the fee structure with them from the very beginning. Learn about the market. As you are getting set up with your broker, take this time to start reviewing the charts and the information that are present about your chosen security. As a beginner, it is probably best to pick maybe a handful of securities to work with, and don't work with all of them on the same day. Have a rotation, so if one security isn't doing well on a particular day, you can check out the others and use them for investing instead. You need to learn as much about the market for that security as possible. Pull out charts on that particular security, looking at how it is done today and on a daily basis over the past few weeks, and even after a few months or a few years. While options trading only takes place within one day, it is still a good idea to look at larger ranges to get a good idea of how the stock has performed in the past and how it is likely to perform in the future. We will take some time to explore more about these analyses, but you may find that working with fundamental analysis and a technical analysis at this time can really help you make smart decisions with investing. First is the technical analysis. This is basically what we already talked about, where you will spend time looking over the charts, the history of how the security has performed, and information about the market, and then base your investment decision on that information. Another option you can use when learning about the market is known as a fundamental analysis. With this method, you're going to look a bit further than the numbers on the page. You will look at who runs the company, what products the company sells, how long the company has been in business, the amount of debt to the income they have, and more. To some investors, knowing these things makes it easier for them to decide whether or not they want to invest in a company. Take advantage of all the tools that you can get your hands on. Use the charts. Find some reputable news organizations. And then, if your broker is able to provide some additional materials, make sure that you use these too. While you don't want to spend months looking over the charts, because then you will miss some great trades, and the market is constantly changing anyway, to spending too much time can leave you behind, getting a good overall understanding of your chosen securities can make trading easier later on. Experiment a little. In some cases, your broker may be willing to give you a trial run on the platform that they use. If you are given this opportunity, then take it. This not only helps you to get familiar with the platform and see if you like it, but it also allows you to do a few simple trades and see how you would fare if you were using real money. You can execute a few trades and figure out what you need to work on, maybe see if 1 or 2 strategies work for you or more. Now, not all brokers are going to offer this kind of service to their customers. If it isn't offered, there are still chances for you to play with the market and see what will happen. You can pick a stock or two that you would be interested in, and then pretend that you invested. Follow the stock, using the strategy that you choose, and then see how the trade would go. This can help you in a few ways. First, it gives you the chance to watch the market and try out a few trades, before you have to put your actual money into the investment. Yes, you may miss out on some good trades that may have made you some profit, but this is a time for learning. And it can protect you from some bad trades as you get more familiar with the market. Once you have had a chance to do a few trades, you can then enter the market. You have a bit of experience behind you, and maybe even more cautions with the trades, because you know that, after the experiment, a few of your trades wouldn't have gone as well as you had thought. Decide your entry and exit points. When you enter into the stock market, especially with options trading, you must have a strategy from the very beginning. If you just go in with the idea that you want to make money, which is a given because who wants to go into options trading or any other type of trading and lose money, and nothing else planned out, you're going to end up losing a ton of money very quickly. Having a plan to enter the market makes things work out well, because you will enter at the time that provides you with the highest potential for profits. Many people like to look at the moving averages of the security, and then when they see that the security gets under this point, they will enter the market. This allows you to get the security for a discount compared to normal and increases your chances of earning any profit, while also increase how much potential profit you can earn. While picking an entry point may make sense, many people wonder why they need to spend their time coming up with an exit strategy as well. Shouldn't you stay in the market as long as possible and get out as much as you can? The problem here is that the market with options trading is going to be very versatile, and there will be lots of ups and downs that come with it. If you aren't careful about it, and you don't make a plan, you may end up losing more than gaining. If you were able to enter into the market below the moving average, then your exit point should be either when the security reaches the moving average or slightly above this point. Only set the exit strategy above this point if you have plenty of evidence to prove that it will actually get there. Then, as soon as the market moves up to that point, then you can end the trade and enjoy the benefits of your profits. It is also a good idea to set an exit strategy in case your trades don't go the way that you want. While everyone hopes that they do a good trade and see profits, even the best traders are going to run into trouble sometimes. The market doesn't always react the way that we would like, and it may go down, even when the signs were all pointing up. Without a good exit strategy in place, it is easy to make mistakes with the trading and then stay in the market too long, resulting in a lot of lost profits. Set a small exit point on this one so that if you do lose money, at least it is only a little bit. Overall, if you are careful with your trading, hopefully you won't have to use this, but it can really help to protect your investment, and you can always re-enter the market later if you find it steadies out later in the day. Chapter 5. Trends and Ranges. Broadly speaking, markets tend to move in one of two ways, either in trends or within ranges. Trends refer to movement in a particular direction, either down or up. Ranges refer to the sideways movements when there's no real progress on either side. How are trends and ranges formed, you might be wondering? Well, it all comes back to the order flow. Remember how buyers and sellers are constantly negotiating over prices. If you demand for a particular stock being to exceed the supply, the price is going to rise. In other words, buying pressure and volume is higher than the supply or sell side. The opposite happens in case of a downward move. It is important for you to see trends as a result of this interaction instead of just geometric shapes. Understand where those shapes come from, and you'll unlock a lot of the market's mysteries. Trends. This shows what a trend in the market usually looks like. An uptrend. As you can see, the overall movement of the price is upwards when viewed from left to right. But look at the gyrations that order flow price undergoes before it gets there. In fact, before that last push up on the right, it looked as if the price was ready to give up on the uptrend and turn downwards. This is why trading the markets in a directional manner is so hard. Markets are not clean. Price never goes up in a straight 45-degree angle or decline the same way. It moves up and down while going up and down, if that makes sense. If you look at trends as simply being a geometric thing, where you apply the logic that if the right-hand side is higher than the left-hand side, then it is a trend, well, you'll end up donating all of your capital to other traders in the market. When viewed from an order flow perspective, things become a lot clearer. Notice how there are bullish and bearish bars in this trend. Well, this is because bulls and bears exist. One side is trying to push prices up, and the other is trying to push prices down. The struggle between the two sides is the only constant in the market. The degree to which one side has supremacy over the other determines the angle of the trend and the cleanliness of it. Think of it this way. All the orders in the market constitute 100% of the order flow. What proportion is controlled by bulls and what by bears? In the uptrend given above, how many times the bears keep coming in and stopping the bulls? It's safe to say that it is a significant percentage, yet the bulls keep pushing the price up, so they're in a majority. Another uptrend. What is the respective proportion here? Obviously, the bulls control a far larger percentage of overall order flow here as compared to the first uptrend. However, notice that the proportion seems to change. The left half of the trend is very different from the right half of the trend. Visually, we can see this. But are there some concrete pointers we can develop to nail down how to determine to order flow dominance percentages? Well, I'm glad you asked. Briefly, here they are. 1. Size of the with trend versus counter trend bars. 2. Frequency of with trend versus counter trend bars. 3. The angle with which price moves in a trend. 4. How far back into the trend do counter trend reactions go? 5. How much progress does with trendy bars make? Looking at the left of the second uptrend, we see that bullish bars are bigger and far more frequent. The price moves at a steep angle, and counter-trend reactions are pretty small and are all easily overcome by bulls to make constantly new highs. Contrast with the right-hand side of the second uptrend and note the differences. You'll see that as the price moves higher and higher, the counter-trend reactions grow from small to pretty big until, after the middle of the figure, it manages to undo the entirety of the previous push upwards. Price eventually bounces from a level and moves upwards at a far shallower angle than previously, with bearish bars becoming more frequent. All market action follows this pattern. At first, one side is dominant and the other is weak. Eventually, over time, the other side begins asserting more dominance, and eventually what was once the weak side becomes dominant again. The place where this change of power takes place is within a range. Ranges. Ranges occur in two places, either at the end of a trend or within them as small sideways movements as the trend takes a breather. The order flow characteristics of both types of ranges are very different, so let's examine them in more detail. First, the ranges that occur within trends can be seen as continuation ranges. In other words, the trend traders are taking a small break from their dominance before pushing higher. You can think of it as a high-powered sports car accelerating at top speed that needs to refuel every 20 minutes because it drains itself. Of course, as trends move on, these ranges get bigger, but even these bigger ranges are indicators of trend continuation. Only when the trend reaches a situation where the order flow is far more evenly balanced does it become indicative of a change in direction in the trend. This is the situation that is happening in the first uptrend. Notice how strong the counter-trend traders are in there. Price is probably heading into a range where the order flow balance is going to be 50-50. These 50-50 ranges are called accumulative or distributive ranges and occur at the end of trends. Accumulative ranges are where ownership of the stock is transferred from bearish traders to bullish ones. The bulls are accumulating stock to push it higher into a bull trend, reversing the bear trend. A distributive range occurs at the top of a bull trend, where sellers are absorbing the buyers and are getting ready to push prices downwards into a bear trend. Such ranges tend to be quite big and often take up large spaces on the chart. They're tough to spot at first, since being so huge, it's difficult to pinpoint the moment when they begin. This illustrates a classic accumulation range. A range. The range in the illustration occurs after the bearish trend. Notice how it has an upward lilt to it before it finally breaks out upwards. This is the thing about such ranges. They don't go perfectly sideways, and you need to view them in the big picture context to understand what is going on. Support and resistance. One major part of analysing the big picture is to understand how support and resistance works. There is a lot of literature on the topic, but unfortunately, almost all of them seem to treat it the wrong way. Before I get into that though, what is support and resistance? SR. As we've seen so far, the market is full of traders constantly negotiating on price, which makes up the order flow. There happen to be some places on the chart which are significant and affect the supply and demand of the stock. Taking the example of a physical market, let's say you set up a stall to sell Christmas trees in the middle of summer. It's unlikely you're going to have a lot of demand, unless you're in the southern hemisphere. However, during December, you will likely do great business. The seasonality of the Christmas tree market directly affects the supply and demand and the prices as a consequence. Similar phenomena take place on the price chart, except instead of seasons of time affecting price, it is prior price levels. When the current price reaches those important levels, traders become conscious of them, and supply-demand dynamics change. All of this is a fancy way of saying that there are places on a chart where price bounces, support, and halts at resistance. You can figure out these levels in advance, and as the price approaches them, you can draw conclusions about its behaviour and thus place profitable trades. At this point, beginners usually rush out to draw each and every single SR level on their charts and end up with more lines than clarity on them. Let's first look at what SR levels look like. Types of SR levels. There are three categories of SR you should look out for and pay attention to. 1. Prior levels where price bounced or reacted from previously. 2. Swing points. 3. Higher time frame levels. Let's look at the third point first. This refers to levels which are important in the higher time frames but don't necessarily show up on the lower ones. For example, if the price is approaching a level it previously bounced massively from, and as this bounce and level show up quite clearly on the daily, you can bet that this price level is going to be important even on the lower time frames. The graph below illustrates this phenomenon. H4 chart reaction. The graph is the 4-hour chart of an instrument. Looking at just this chart, if we were to look at just the push into the two horizontal lines at the top of the chart towards the right-hand side, it seems inexplicable as to why the price would suddenly turn downwards. After all, the push into the two lines was quite strong, as evidenced by the strong bullish bars heading into the level. Well, the answer can be found on the higher time frame, the daily chart. This is shown in the graph below. Daily chart. On the daily chart above, the final move into the two horizontal lines is the one we are looking at in the H4 chart reaction. You can see that there are two prior reactions and that the two lines indicate a good SR level on the daily chart. Notice how despite the strong push into the level on the H4, the price still respected the daily timeframe's SR level and turned downwards. The illustration of the daily chart is a good example of the first type of SR level from the list above. Places or levels where price has reacted from previously have a good possibility of creating a reaction once more as the price approaches the same levels. The greater the number of previous hits and the greater the reaction from that level in the past, the better. From the daily chart, we can see that the level held twice previously and therefore, as price approached it a third time, it held once again. In the future, if the price approaches it for the fourth time, this is a great place to short once again, since it is likely that price will react at this level and move downwards. When does it finally break through? Well, we can't know this. However, as traders, we will short this level until price breaks through. Chapter 6. How to get started in options trading. Walking you through the learning curve of options trading will always start with the most basic move you'll need to make, setting yourself up in a position to actually be able to trade. To do that, you're going to need an options account. It's important that you know your starting point and just how easy it is to reach it. One thing to know before you pick your firm: times have changed considerably over the last couple of decades when it comes to options trading. Back before the internet became such a constant part of our lives, your brokerage firm, or at least your personal representative at the firm, would make your options trades on your behalf, and you paid a hefty price for their services. Nowadays, however, you'll be doing most of your trades yourself. Commission for your representative is thus a whole lot lower than it used to be, which means it won't cost you an arm and both legs to rely on your rep in the early days of your experience. While you are learning, feel free to make use of your firm's services to place and confirm your trades if it helps you feel more comfortable getting to know the process. With this in mind, there are going to be certain things to look for when you select your firm. Compare commission prices to make sure you're getting a great deal. Make sure the firm has up-to-date software and is capable of setting up trades quickly and reliably to make sure you get those trades you want at the best prices. Check out the hours of service to ensure they are compatible with your needs. In these days of online firms, you could be dealing with a firm that's across the ocean from the markets you have an interest in, or you might find that a firm only makes its reps available for the length of the working day, which might not suit your own timing. Speak personally with the reps at the firm, as these are the people who are going to help you during the process of setting up your strategy. You want someone who is personable and knowledgeable, and most importantly, who speaks in terms that you personally find easy to comprehend. Take a look at the additional services the firm supplies. Many will offer learning materials, guides, and even classes or webinars to help you hone your strategies. Even if you feel that you know all you need to know already, there's no harm in a refresher course or a little nugget of inspiration every once in a while. Once you select a firm, you'll then need to consider signing a margin agreement with that firm. This agreement allows you to borrow money from the firm in order to purchase your stocks, which is known as buying on margin. Understandably, your brokerage firm is not going to allow you to do that if you don't have the financial status to pay them back. They will therefore run a credit check on you and ask you for information about your resources and knowledge. A margin account is not a necessity for options trading. You don't actually use a margin to purchase an option, because it must be paid for in full. However, it can be useful as you graduate to more advanced strategies. In some cases, it will be obligatory. If you opt to sign a margin agreement, talk it through thoroughly with the firm, as there are certain restrictions on the type of money you can use that may apply to you. Next, you'll need to sign an options agreement, and this time, it's an obligatory step. This agreement is designed to figure out how much you know about options and how much experience you have of trading them. It also aims to ensure that you are absolutely aware of the risks you take by trading and make sure that you are financially able to handle those risks. By ascertaining these things, your firm can determine what level of options trading you should be aiming for. It will therefore approve your trading level, of which there are 5. You may sell covered calls. Level 2. You may buy calls and puts and also buy strangles, straddles and collars. You may also sell puts that are covered by cash and by options on exchange-traded funds and indexes. Level 3. You may utilize credit and debit spreads. Level 4. You may sell naked puts, straddles and strangles. Level 5. You may sell naked indexes and index spreads. Don't worry if you're not sure what each of these things means. You will be by the time you finish reading this book. For now, all you need to be aware of is that your firm will determine for you which level you should be at. As a beginner, don't be surprised if you only reach the first 2 levels. Once you've signed the agreement, you'll be handed a booklet that contains a mine of information about risks and rewards within options trading. Right now, if you were to read that booklet, it would seem to be in a foreign language. But by the time you finish this crash course, it will be a lot more decipherable, and it's very important for your success that you do read it. Finally, your firm will present you with a standardized option contract. It's the same for every trader, which means you stand the same chance of success as every other person out there in the options market. By trading an option, you are entering into a legal agreement that is insured by the Options Clearing Corporation, which guarantees the contract will be honoured in full. Make sure you read that contract to be aware of not only the rights you have as a trader, but also the obligations you must follow in the same role. Congratulations, you have an options account. This is the conduit through which you will create and implement your strategies and begin your adventure in options trading. Learning the lingo. Options traders speak their own language. It's not meant to confuse you. It's just the natural process of creating shorthand by which one trader can converse with another more easily and thoroughly. Of course, it does make it difficult to plunge into the waters of trading if you can't speak that language. A lot like trying to decipher road signs in a foreign country. It makes it hard to know the right direction, or even where you're standing right now. We're going to take a look at the common terms you'll be dealing with as you enter the world of options trading before we begin taking a deeper look at your strategies. Don't worry about trying to learn them by rote. They will all become clear as you forge onwards. This glossary will always be available to you to check on meaning if you need to. Strike price. A price per share agreed upon before an option is traded. At this price, a stock may be bought or sold under the terms of your options contract, also known as the exercise price. Bid-ask. The latest price that a market maker has offered for an option is at its ask price. In other words, it's what the seller is willing to accept for the trade. The latest amount that a buyer has offered for an option is the bid price. Premium. The premium is a per-share amount paid to the seller to procure an option. The seller will keep this premium no matter whether the buyer exercises the right to buy or sell the stock at the deadline. In the money. Often shortened to ITM. This means that the stock price is above the strike price for a call or below the strike price for a put. In other words, it is now at the right price to be traded. Out of the money, often shortened to OTM. This means the price is below the strike price for a call or above it for a put. Such an option is priced according to time value. At the money. The strike price is equal to the stock price. Long. In this context, long is used to imply ownership. Once you purchase a stock or option, you are long that item in your account. Short. If you sell an option or stock that you do not actually own, you are short that security in your account. Exercise. The owner of the option takes advantage of the right to buy or sell that they purchase by exercising it. Assigned. When the owner exercises their option, the seller is assigned and must make good on the trade. In other words, they must fulfill their obligation to buy or sell. Intrinsic value. Time value. The intrinsic value of an option refers to how much it is ITM. Most options also include time value, which refers to how long left until its expiry. This time has value because during that time, the stock can still change in price. An OTM option has no intrinsic value because it's a loss, but it does have time value because that loss might change. Time decay. Linked to time value, this term refers to the fact that as time ticks on, the amount of time value slowly decreases. At the expiration date of the options contract, the contract has no time value and is worth only its intrinsic value. Index options, equity options. Index options are settled by cash, whereas equity options involve trading stock. The main difference between these two types of options is that an index option usually cannot be exercised before the expiry date, while an equity option usually can. Stop-loss order. This is an order to sell either an option or a stock when it reaches a particular price. Its purpose is to set a point at which you, as the trader, would like to get out of your position. At this price, your stop order is activated as a market order. In other words, by looking for the best available price at that moment in order to close out your position. These are the most common terms you will hear used as you venture into the world of options trading. It's worth mentioning that as you extend your understanding, you'll encounter more. However, these are plenty to help you decipher your first trades and get stuck in. Chapter 7. Common mistakes beginners make and how to avoid them. Alternatives exchanging is essentially every merchant's focal point, and you can make attractive benefits from it as well. In the event that you have come this far in the book, at that point you definitely know the potential that this field has. Yet on the off chance that you make an inappropriate exchange, it tends to be similarly annihilating for your vocation. Along these lines, on the off chance that you need to pay attention to this, here are a few missteps that are regularly made, and once you know them already, you will reconsider before making them yourselves. Not following any arrangement for exchanging is likely the most widely recognized errors of all, particularly among the fledglings. It may be that you read in some fund magazine that a specific organization's stocks are performing admirably, or possibly you got a tip at an arbitrary get-together and you chose to act it. All things considered, would it be a good idea for you too? The appropriate response is both yes and no. No, in light of the fact that you ought to never take anybody on their promise with regards to exchanging. Indeed, in light of the fact that it may really end up being a decent tip in specific cases. However, you initially need to perform speedy research of your own and afterward choose whether that tip would merit accepting or not. On the off chance that you don't have an exchanging plan before you plunge into the universe of alternatives exchanging, it is essentially as though you are driving your vehicle but you don't have a permit. Thus, when you face a circumstance of emergency, the misfortunes can be gigantic. In alternatives, you don't have constantly on the planet. There is a fixed measure of time in which you need to make a move. In any case, your choice will lapse uselessly. You generally must be alert for any open doors that may come to your direction, and if there is a chance, absolutely never miss it. In this way, your objective of raking in some serious cash may not simply be in support of yourself, since you didn't make an arrangement for it. Recall that regardless of how great your methodology is, here and there even they can bomb when you don't have an exchanging plans. A portion of the things that your exchanging plan should have are the sort of choices that you are especially keen on, like nifty, value, wares, etc. The measure of cash that you can stand to put resources into exchanging on a month-to-month premise, the measure of cash you need to put resources into each exchange, your hazard hunger, and your normal comes back from an exchange. Ensure that this arrangement is followed for each exchange that you lead. You will get allurements of going out of control, yet you need to oppose those enticements and keep yourself from gambling excessively. Your dread and insatiability both must be controlled in the event that you need to become wildly successful. On the off chance that you are only an amateur, start little and afterwards stir your way up to the top gradually and consistently. Believing in the one-size-fits-all concept. Choosing the technique that would work best for you relying on the circumstance of the market is the thing that alternatives exchanging are about. Assume you made sense of a decent methodology and you have been utilizing it for a long time, and it is turning out to be well for you. Yet that particular system isn't intended for a wide range of exchanges. For instance, you can't utilize techniques of a bullish market in a bearish one. In this way, in the event that you continue rehashing your technique without assessing the exchanges, imagining that it will work like some enchantment wand and make you win each exchange, at that point you are incorrect. You need to figure out how to anticipate the market standpoint and afterward pick the system that is best for you. You need to perform a specialized investigation and principal examination to discover which procedures you should utilize. Both full-scale and microeconomic elements must be thought about. Assemble the information from better places by understanding books and going to workshops. Peruse the perspectives on specialists from various presumed account magazines. After you have made sense of the market viewpoint, picking the correct technique would turn out to be a lot simpler. Ignoring the expiration date. The lapse date of alternatives is one of the main considerations influencing our exchanges. As you realize that, so as to make benefits, you need to hypothesize on the heading of the stock development. Indeed, simultaneously, I am likewise requesting that you conjecture how much time it is going to take a specific point in light to the fact that, on account of alternatives where your time is constrained by the termination date, it can't take you for eternity. Let us state that you looked into and discovered a few factors that can emphatically affect the cost of the stock. Yet do you know when that cost is going to arrive at the level you need it to reach? Exchanging doesn't just mean taking care of procedures. On account of alternatives, you need to pay special mind to the lapse dates too. Much the same as the techniques, with regards to the termination date, you have a large number of decisions for it as well. Be that as it may, you know when you've experienced the last point, that is when you have constructed your market standpoint. Agreeing to the correct termination date sort of turns into the simple undertaking. There are a few inquiries that you should keep in your agenda, since then it becomes to make sense of it. For instance, you can ask yourself how much time you figure a specific exchange will require to play out. You can likewise ask yourself whether you need to hold an exchange through significant occasions, this like a stock split or an open declaration. In conclusion, you ought to likewise ask yourself whether you have the necessary liquidity to seek after this. Over-leveraging the trades. It is constantly encouraged to apprentices to become accustomed to stock venture before you start alternatives exchanging. At the point when you have done stocks contributing first, it is almost certain for you to have taken care of tremendous measures of cash straightforwardly, and actually, purchasing stocks legitimately additionally applies that you need to follow through on the whole offer cost. Along these lines, for this model, let us state that you are an individual who has the capacity of purchasing stocks worth $1,000 at once, and suppose that you have done this previously, however not in alternatives. Since you have exchanged over to the alternatives in view of their modest nature and that they are a subsidiary, in the event that you needed to purchase the basic resource legitimately with all your cash, it would have cost you way more cash than what you were putting resources into buying the choices. Thus, you don't have to contribute $1,000 for buying that numerous measures of stocks as choices contract. Be that as it may, this additionally represents a hazard, where you may wind up over-leveraging. Influence is a useful asset just when you use it astutely. Thus, in light of the fact that there is influence doesn't imply that you ought to contribute more sum than would normally be appropriate. That is the reason there is an extremely normal guideline that is followed. Think about it as a dependable guideline for your situation. Attempt and breaking point your misfortune to inside 5% for each exchange that you do. This is something that you need to carefully maintain with the goal that all your capital isn't lost behind a specific exchange. At the point when you just lose some cash in an exchange, you can generally pick yourself back up and put resources into an alternative exchange. Which carries me to the following point. Error in position sizing of your trades. There are two basic feelings that are answerable for all blunders identified by position estimating. These feelings are insatiability and dread. Assume you are settling on a choice and you become too voracious about your benefits, At that point, it may happen that you position your exchange too large, that it isn't directly for the size of the record that you have. Furthermore, this is much increasingly normal when your standpoint of the market isn't right, and afterward what you receive consequently isn't benefit, yet a devastating misfortune, recuperating from which can turn out to be extremely troublesome. This was only one mix-up of position measuring. The other one is the point at which you position your exchange excessively little. There is nothing amiss with exchanging little, yet do you know what it implies? It implies that you probably won't find the opportunity to make any considerable benefit whatsoever. Here are some basic manners by which you can keep up fitting position estimating. Make sure the hazard rate for each exchange is something like 1 to 5% of your complete record esteem. For each exchange, it is better that you adhere to reliable dollar esteem like $100 or $1,000 dependent on the amount you can bear to hazard. Regardless of what you do or which technique you use, your position measuring ought to be with the end goal that you are open to taking a chance with that measure of cash. In less difficult terms, regardless of whether the exchange doesn't occur like you anticipated it to be, it shouldn't be all that difficult for you to lose the cash contributed. In the perfect case, your exchange worth ought to be with the end goal that it is sufficiently important, however not very enormous that it has the motivation to cause you to lose your rest around evening time. Chapter 8. Options Greeks. Did you know that Greeks are 5 parameters denoted by Greek symbols or letters that quantify the way the price of an option will change? At any given time, you can look them up to get their values. We start by looking at intrinsic value, that is how the price of the option changes or varies with the underlying stock's price. Delta. If you look at the data for any option, you're going to see 5 Greek letters, usually expressed by their English spelled names: delta, theta, gamma, vega, and rho. The first of these is delta, which tells you how the price of an option changes with the price of the underlying stock. Put options have a negative delta, which just indicates that a put option has an inverse relationship to the price of the underlying stock. That is, if the price of the underlying stock goes down, the value of a put option goes up, and if the price of the underlying stock goes up, the value of the put option goes down. So if delta is minus 0.26, and the price of the underlying stock went up by $1, the value of the put option would drop by 26 cents. On the other hand, if the price of the underlying stock had dropped by $1, then the price of the put option would rise by 26 cents. Delta is dynamic, and the number always changes when some important parameter in the option price changes. Consider an option on a stock that is trading at $102 with a strike price of $100, with 14 days to option expiration. In this case, the price of the call option is $2.48 and delta is 75 cents. The price of the put option is 47 cents and delta for the put option is 25 cents. So if the price of the underlying stock goes up by $1, we expect the call option to rise to $2.48 plus 75 cents equals $3.23. The price of the put option would decrease to 47 cents minus 25, which equals 22. That's just about what happens, but in reality, the relationship isn't quite exact since other things impact the price of the options. The call option increases to $3.84, and the put option declines in price to 27 cents. We said it's dynamic, and what happens when the share price rises by $1 is the delta values for both options change as well. Now delta is 84 cents for the call and minus 16 for the put. That tells us something important, namely that delta is higher the more in the money the stock is. We can see this looking at some real options. Considering an IBM $124 call that expires on the 6th to the 28th, it has a delta of 0.967. A $139 call that expires on the 6th to the 28th has a delta of 0.5388. The share price is $139.20, so the $124 call is more in the money. The $139 call is practically at the money, and we learn a second important fact about delta. That is that at the money options we'll have a delta that is reasonably close to 0.50. Since the more in the money you are, the higher delta, which means in the money options can benefit or be hurt by a $1 change in the price of the underlying stock. Something else that happens is that if the option is in the money, the closer you get to expiration, the higher delta goes. For our example of an option with a $100 share price, if the underlying stock price remains at $103, moving to 7 days from expiration, delta jumps to 0.92 for the call. Moving to 3 days to expiration, delta is 0.98. So if you're expecting a stock price to move a lot in the next few days, getting an option that will expire soon before the move happens could be a worthwhile investment. Remember that the money options have a delta of about 0.50, and when you get close to expiration, delta for a call will be exactly 0.50, and for a put, it will be minus 0.5. If the option was on the money, actually buying at the money options can be quite difficult, so you'll probably have to settle for something close. The closer to the expiration date you get, the smaller delta gets. In fact, a few days away from expiration, delta can get vanishingly small. An out-of-the-money call option for a strike price of $100, share price of $97, with 3 days to expiration will have a delta of 0.02. The delta for the same put option will add up the difference to 100, but remember it's expressed as a negative value. In this case, a put option with the same parameters, so a strike price of $100, will have a delta of 0.98 if the underlying price is $97. In that case, the put would be worth $3, and if the underlying share price dropped to $96, the price of the put would rise to $4. Then you'll see delta increase to -1 for the put and drop to 0.00 for the call. If the stock had moved the other way, raised in price by $1, then delta for the put would drop to -0.92 instead, and the price of the put would drop to $2.04. The bottom line is delta will give you a good estimate of how much the price of the option will change when the price of the underlying stock changes by $1. If it's a call option, the relationship is direct and delta is expressed as a positive number. For put options, since the relationship is an inverse one, delta is a negative number. And remember that if you take the absolute value of delta for the put option and add it to the delta value for a call option that has the same strike value and date of expiration, they will sum to 1. Gamma. Gamma is like the second derivative. In other words, it tells you how delta itself changes. This is important since we noted that delta was dynamic. However, beginning traders don't need to dive into this too deeply, but you can check gamma to see about how much delta will change if there is a $1 change in the price of the underlying shares. Gamma has the same value for both puts and calls. So if gamma were 0.22 and delta was 0.24 for a call option and -0.76 for a put option with the same strike and expiration date, we'd expect a $1 rise in share price to cause delta for the call option to increase to 0.46, and the delta for the put option would change to -0.54. This is about what would happen, but remember if the option was at the money, the values of delta would move to 0.5 and -0.5 respectively. Theta. When examining options, theta is a very important parameter among the Greeks. What theta gives you information about is the time decay of the option. Theta is expressed as a negative number, reflecting the fact that time decay causes a decrease in option price as time goes on. Let's consider a couple of examples. Suppose that we have call and put options with a strike price of $100 with 3 days to expiration. The price of the call is $1.20 and the price of the put is 20 cents. If the share price of the underlying stock is $101. In this case, theta is -0.073 for both the call and the put. That tells us that if nothing else changes, the price of each option will decrease by 0.073. The The call option is priced at $1.20 and the put is priced at 20 cents. Moving to 2 days to expiration and leaving everything else the same, we find that the price of the call option drops to $1.12 and the price of the put option drops to 12 cents. So it moved in almost exact accordance to what was expected. The following day, theta has increased to minus 0.079, reflecting the fact that time decay happens more rapidly the closer you get to the expiration date of the option. In fact, with everything else unchanged, 20 days to expiration theta is about half as strong, at minus 0.035. That reflects one of the fundamental truths of options, that it is that time decay happens in an exponential fashion, with time decay happening faster the closer you get to expiration. One of the things that help makes options seem complicated is that all of these variables are interdependent. So at 20 days to expiration, suppose the stock price shot up to $108. In that case, theta decreases to minus 0.005, so it's only 1/7 of the previous value. It decreases in the put option as well. Theta is also proportional to share price, so theta is larger if the share price is larger. Consider a stock with a share price of $975 and a strike price of $1,000. In that case, theta is minus 0.282 for the call option and minus 0.274 for the put option. That means if a day passes and nothing else changes, the value of the call option, which in this case is $5.15, will drop by about 28 cents, and the value of the put option will drop by about 27 cents. Vega. The next Greek that we are going to meet is Vega, which tells us the relationship between the price of the option and the implied volatility. What Vega tells you is how sensitive the option is to changes in the implied volatility. Generally speaking, an in-the-money option is less sensitive to changes in implied volatility, while an out-of-the-money option is more sensitive to changes in implied volatility. Specifically, Vega tells you how much the price of the option will change if the implied volatility changes by 1%. Remember that options that have higher implied volatility are worth more money. Suppose a stock is trading at $500 a share, and the strike price is $490, with 10 days left to expiration, and implied volatility of 23.5%. Vega will be 0.285. A call will be priced at $13.73, and the put, with the same parameters, would be priced at $3.69. If the implied volatility increased to 24.5%, then the call would be priced at $14.02, and the put would be $3.98. When you are in long positions, Vega is positive, and it's negative for short positions. Rho. Rho is a measure of the option's pricing sensitivity to a change in the risk-free interest rate. Since interest rates don't change by that much or that often these days, Rho isn't paid much attention to. In a radically changing high interest rate environment such as existed in the late 1970s, Rho would be a more important parameter to pay attention to. Chapter 9. A strategy for passive income in 7 days. As promised, this book is meant to help you increase your passive income in just 7 days. Since you are day trading, you should be able to earn profits every single day from your trades. With that being said, you're going to want to be earning above your investment income so you can have profits that you actually feel comfortable cashing out with. To help you get started with the best strategy for you to win with, I have outlined 3 ways that you can start making passive profits in just 7 days. If you follow this exact blueprint, you will be making profits quickly, allowing you to completely change the scope of your finances both now and in the future. After you have made your profits within 7 days' time, you can go ahead and rinse and repeat by applying the same method over and over again, enabling you to continue earning and increasing profits from your trades. Choosing your day-to-day strategy. The first 7 days of trading are crucial, but so is every single day after that. For that reason, we are going to look at the first 7 days and then every day following as 2 separate things. The first 7 days will help you build your foundation. whereas every day afterward will help you maintain that foundation and continue earning a strong profit. For the first 7 days of your trading, you need to decide what you are going to do that is going to help you earn the most profits possible. Since you are likely brand new to day trading options, I suggest starting out fairly modestly to ensure that you do not get too overwhelmed. If you overwhelm yourself early on, it could make trading harder in the future. I suggest starting in the simplest way possible by using the following strategy. On day 1, complete 1 trade. On day 2, complete 2 trades. On day 3, complete 2 trades. On day 4, complete 3 trades. On day 5, complete 3 trades. On day 6, complete 4 trades. On day 7, complete 4 trades. At this point, you can either stay with completing 4 separate trades or trade strategies every single day, or you can further increase the number that you manage until you are reaching your desired profits. Make sure that you never exceed a number that you can reasonably manage to avoid overwhelming yourself and possibly tanking several trades due to confusion and overwhelm. When you have reached your chosen number of daily trades, stay there and consider that to be your daily strategy. Ideally, you should never exceed this number of trades on any given day so that you can earn your profits while still staying level-headed and calm enough to manage them all. Make sure that you factor your everyday routine for other areas of your life into how many trades you take on, as you are not going to want to overload your schedule. If you are doing this for passive income, you will not want to spend every minute that the stock market is open glued to your computer as a professional day trader would. Building your own routine. When you start out trading, I strongly advise you to start out by building your own routine right from day 1. Take the time to decide what time you like to check in on the markets, when you are going to start your watch list and technical analysis, and how you are generally going to engage in trading. If you need to set alarms each morning to alert you throughout the day, make that a part of your routine. If you like to sit down with a cup of coffee and your tablet so you can check in on the market each morning, make that a part of your routine. If you like to check in on your lunch break and your afternoon break, make that a part of your routine. Creating a routine in trading is less about having a frivolous schedule to follow and more about instilling strong habits into your trade strategy from the very beginning so that you always make the best moves possible. This way, you can feel confident that you will not miss out on the best positions, mismanage your trades, or forget about your trades and have them cancelled at the end of the trading day. As a result, you will be able to feel more confident in your trading and trade management strategies while also continually improving your strategies as you go. The 30% rule. Lastly, I present to you the 30% rule. The 30% rule has less to do with your bottom line and actual trade strategy, and more to do with your money management strategy. When it comes to trading as a way to earn any form of income, even a passive income, you want to make sure that you are never cashing out on more profits than you can reasonably handle. The idea with trading is that you will create profits that increase the amount of investment capital over time, meaning that you can afford to make larger investments and therefore earn larger profits from your trades. With that being said, you do want to make sure that you are cashing out on some of your capital to ensure that you're always earning an income from this strategy which makes it worthwhile. The 30% rule states that you never take more than 30% of the profits that you earn from each trade out of your trading account. So, if you invest $50 into a trade and earn $150 from it, your profit is $100. Probable tips and suggestions to try to succeed with options trading. Becoming an options trader who consistently enjoys success in his endeavours is not just something that you find yourself achieving overnight. You require to spice the process by bringing in new ideas and concepts that may seem probable. When these tips are incorporated in the right way, you will surely find yourself up the ladder of success with a lot of ease. This article will equip you with some of these tips that you may use to your advantage. One of the key tips is in ensuring that you focus on the prices of the options. You realize that options grow more and more worthless as time goes by, simply because at the end of the day of it all, they will finally expire. This is a characteristic shared by all the options, no exception. The majority of the option traders will make the mistake of laying so much emphasis on studying the market as well as the stock. They usually make their decisions on whether to buy or sell their options based on this. They often forget the prices of these options. You should always focus on buying low-priced options and sell the higher-priced options. Being able to differentiate lower-priced options from cheaper options in the market is one of the steps towards success in options trading. A low-priced option usually provides a very high return. Failure to consider this factor of options prices may just make you end up accumulating losses. When the options are well thought of and analysed properly, they can be very rewarding. Another tip is to ensure that you have the necessary tools to stay in the market. Your risk management strategies should be well outlined. Your option trade can turn out to be the most successful if you manage your risks appropriately. However, the majority of the option traders usually focus on the amount of money they plan on getting and forget the losses they risk accumulating. You realize that most of the decisions that you make in option trading will be influenced by this factor. As for the case of the amount of capital that you would invest, you would only risk investing that amount that you would bear to lose in case things worked against you. Most of the option trading strategies, however, are quite risky, but you can try out various risk management strategies so as to minimize losses as much as possible. Enormous losses have the potential of affecting you for even a whole month or even make you exit the trade. Creating a good game plan that is quite quantifiable is a major tip in assuring success in options trading. Make sure that the goals outlined in the strategy are quite clear and realistic. They should not set the bar too high or rather appear inachievable in any way. With a clear strategy, you are able to focus on the latter. Your strategy should also be strict in a way that assesses all the aspects of your options trading. Ensure that you also exercise the virtue of discipline to your course so as you reap success in an options trade. Your game plan should also be quite flexible to accommodate the changing market patterns. It is quite advisable to trade with a well-known stock, or rather, one that you are quite familiar with. By this, you are able to even predict the price movements of stock. This is usually a very crucial exercise that can reap your maximum benefits. You also do not have to go through a lot of struggles on analysing the stock as you are already familiar with them. However, there is a need to ensure that you consistently do a lot of market research on the same to keep up with the changing trends. For well-known stock, the majority of them enjoys huge volumes and has the tendency to remain in the market for longer periods. The other tip is on the choice of an options trade broker. It is wise to ensure that they offer you with quite affordable or rather user-friendly commissions. High commissions will affect your profitability as well as your strategy. Nonetheless, do not go for the low-fee brokers if they are not in a position to offer you reliable services like better trading opportunities as well as saving you time. Failure to which you may end up losing much of your dollars due to their inefficiency. For online brokers, ensure that they have convenient methods or platforms that can enable easy transfer of money. This decision on the choice of a broker is a decision worth spending a lot of time on. The success of your trade highly depends on the broker you choose. It is quite possible to think that your psychology does not play a key role in the options trade. Many options traders overlook this and end up making decisions that ruin their trades completely. This is quite common, especially when you make huge losses and become emotional. This is very normal and expected, but you should learn that any decision you make while in this state of mind may completely work against you. It is therefore advisable to learn how to react to such losses. Moreover, try as much as possible to combat the fear of losing. This may refrain you from enjoying huge profits that you could have earned in case you entered the trade. Chapter 10. Effective Strategies for Options Trading. Now, let's start sharing comprehensive details about the top 13 strategies of options trading. Covered call. You can trade covered calling options as something you would like to do in a bull market. Are you looking for stocks that are growing, or are you expecting to stay at least in the short trading range for a short time? It is a more aggressive approach and an excellent way to trade covered call options when the market is generally bullish, or you have good reason to believe that selected stocks are rising. However, can you still consider trading in covered calling options when the market is in a primary downtrend? Yes, you can. If the view of the warehouse drops before the expiration date, you can still make money. You choose a conservative approach, and that's how you do it. When creating a purchase listing action, first pay attention to the map patterns and look at the highs and lows when the trends are low. Try to buy stocks as close as possible to the next low trend. It is usually a support line or similar distance from the previous trough to the top in front of it. Naked put. Naked put should be one of the riskiest strategies. Thus, only professionals are best advised to use it. But when that happens, selling naked puts can be even safer and more profitable than buying stocks. When you sell a nude set, you assume that you must buy the stock at a specific price, on or before a certain date. You'll knock the price forward for that. Sales puts can be a good strategy if you don't come overboard. So, if you're selling nude stocks for $50,000, make sure you buy shares for $50,000, as you may need to continue. Even though naked put is safer and more advantageous than stock trading, option brokers consider selling naked put a risky strategy. Your broker would like to know that you have enough money to buy the selected shares if your put is exercised. The formula varies between brokers, but a margin requirement is usually required. 12% of the full purchase price of the stock, if you have exercised it. Why the steep margin requirement? Theoretically, if you buy a stock at put's best price, it is sometimes because the stock collapses and may continue to fall until the stock is worthless, leaving you in the dark with the stock you paid too much. However, if you do not play and do not make an informed decision and choice of your share, this will never happen. Before sharing the final details, here is a graphical representation of naked put strategy. Selling naked puts is the only sensible way to buy stocks because you are purchasing those stocks at a discount. Why pay more? In any case, if you usually invest in stocks, you have enough money to meet your margin requirements. In a neutral or bull market, this is a great way to generate a monthly income. It's safe, reliable, and cost-effective, and best of all, it doesn't require a thorough knowledge of technical analysis. Knowing the basics, performing simple trend analysis, and trading is secure. Bull put spread method. Traders often avoid options trading because they simply do not understand them. If you want to become a better trader and get the most out of your investment dollars by reducing risk, you can learn some of the options trading strategies that will help you do that. Here, we'll be discussing the bullish put spread method in detail. However, before then, let's share information about bull call spread technique for the sake of clarity. As with any trading option, you pay a fee or premium for having the right or option to call, buy, or put, sell 100 shares for a specified period at an agreed price from 21 days to more than a year. For example, you pay a $100 premium for calling GE at 35.5 for 6 months and 10 days. This is the most popular period because all gains of this length are considered long-term capital gains and taxed at 25%. Let's say GE shares rise and start trading at 45.5 before your option expires. Then take the opportunity to make a profit of $900. Shares, 100 shares equals $1,000 minus $100 price equals $900 net profit. The call propagation method favors a bull market or an upward trend. This method requires you to buy a lower call price and write a higher bet at the same time. the call for a lower strike has a better chance of being more valuable due to the bullish market trend. You write with a higher card to protect yourself from adverse market fluctuations. As with any investment strategy, I recommend testing this strategy first with a paper dealer or from practice to make sure you understand the theory of this strategy before you risk real money. Ask a trusted advisor if you have any questions and make sure you know both the potential and the risks associated with your investment or trading strategy. Now, let's talk about the bull-put spread. It is an options strategy used by the options trader when the trader grows against the underlying asset. The trader believes that the asset will be valued. The procedure consists of selling or registering an option with an option to sell ITM, cash, and purchasing an option with an OTM option, money, with the same expiration date. ITM phrases are exercise prices that are higher than the current spot price of the asset. OTM puts realization prices below the current price of the asset. A sold option has a higher premium than a purchased option, which leads to a credit spread. The trader receives a net loan to open a position because the loan is the difference between the premiums for the chosen realization prices. This strategy can be selected based on the trader's choice if the expected volatility of the preferred options is favorable. Implied volatility is an essential factor in price options. Considering that bull-put spread is relatively complicated, it's not ideal for beginners. The advantage of this transaction is that the maximum loss is limited, namely the difference between the selected realization prices reduced by the premiums received. The maximum profit is also limited to the loan secured. This transaction becomes profitable if the underlying asset's cost remains above the current spot price until maturity. The transaction will result in a loss if the price of the underlying asset is lower than the current spot price. This position can be eliminated before maturation, which results in less loss or less profit than when it matures. The trader may also close part of this position at any time before it expires, which may lead to unlimited profit potential. The main advantage of selling or registering options is capturing gains from the option's maturity over time. It is stated as part of the external value and is another crucial factor in setting prices. Volatility, maturity, and to a lesser extent, interest rates are all aspects of the value added of an option. The net asset value of the option is simply on the monetary part of the option value. Stock traders pay special attention to implied volatility and time to maturity. Bear call spreads. Traders' call spread is a strategy that allows you to take advantage of a declining market. One of the most significant benefits of this technique is that you may not be entirely right. While this is a bearish strategy, stocks do not necessarily fall to make money. It can go aside or even a little up. How can this happen? This strategy benefits from the call. A call gives the buyer the right to buy shares at a specific price on or before a particular day. He pays a premium for that. The seller will receive a dividend, but she is obliged to purchase the shares on or before the specified date for a specified price. Thanks to this range, you benefit from the position of a seller. Let's take an example. You find a share of $42 and you think it will go down. You decide to sell a $45 call for these shares. This will earn you $1. How a bear call spread looks like. Finally, if you don't have sufficient knowledge in options trading, you are advised not to apply bear call spreads yet. Long iron butterfly strategy. The long iron butterfly is another trading strategy and variation on the iron condor. Both strategies use a combination of two credit spreads that go in opposite directions, one using calls and the other puts. The difference between the two is the range of bet prices used. Iron Condor has 4 different bet prices and uses the out-of-money options of the body of the set, while iron butterfly focuses on using the same for money as short, i.e. sold, bet prices. Prizes for the body and two long out-of-money options, wings. As a result, iron butterfly gives more credit thanks to the ATM options sold, but also carries a higher risk of the shares falling into the wings, as they tend to be closer to the current trading price of the underlying shares at the time of entry. Advisably, you should not use long iron butterfly strategy unless you have understood the potential risks and reward greatly. Thus, it's usually recommended for the professional traders. However, if the price of the underlying asset rises in both directions and violates external realizable costs, you can do one of the following two things. Either you leave the position to make sure you don't get the underlying stock, or depending on where you think the stock might go from there, you can take advantage of a nice credit spread feature and lose the position for later maturity. In contrast, the other side of the credit spread decreases without risk. Iron Condor. Iron Condor strategy is the primary strategy for options traders who want to take advantage of the stock market without having to choose a direction. Ideally, these options trading works better in non-trending markets. Still, it can also be used successfully during trends and more volatile markets if the trader has the knowledge and ability to spend the time he needs to correct them. Check and adjust. This range takes advantage of theta decline in options, the fact that possibilities rot and lose value over time. When a flat iron condor is located and nearing its maturity, if the sold strike positions are far enough away from the damaged road, these condors can usually be worthless and leave the iron condor trader for a short time. Conclusion. Thank you for making it to the end. Trading options have significant risks. If you are absolutely inexperienced with trading, we would recommend talking with a financial advisor before making any decision. Always keep in mind that every investment has its own risk and reward rating, which means that if the risk is high, the reward will be high as well. Expiration dates of American-style options and European-style options, the commonly used style options, are always the third Saturday in the month for American and the last Friday before the third Saturday for European-style options. Remember that 100 shares of the certain stock are actually one option contract, and if you pay $1 for an option, your premium for that option, whether you buy or sell, it is $1 per share, which means that the option premium is $100 per contract. All of the examples in this guide assume that every option order ever mentioned was filed successfully. Whenever you want to open a new position, you will have to sell or buy on the market to open. The same principle applies if you wish to close your position. You sell or buy to close. The volume of the options is the number of contracts that are traded in one single day. Be careful when signing the contracts. Make sure you read all of the trading options. So here we are, at the end of this guidebook on trading options. Trading options can be extremely profitable, but learning to trade them well takes time. You can choose to use indicators to determine your entry points, and I'm all for this approach at first, but remember that over the long term, you're better served learning the basics of order flow and using that. Qualitative risk management requires you to adopt the right mindset with regards to trading, and it is crucial for you to adopt this as quickly as possible. Remember that the implications of your risk math mean that you need not be concerned with the outcome of a single trade. Instead, seek to maximize your gains over the long term. The learning curve might get steep at times, but given the rewards on offer, this is a small price to pay. Keep hammering away at your skills, and soon you'll find yourself trading options profitably, and everything will be worth it. How much can you expect to make trading options? Always make sure you're well capitalized, since this is the downfall of many traders. You need to be patient with the process. A lot of people rush headfirst into the market without adequate capitalization or learning, and soon find that the markets are far tougher than they thought. so always ensure the mental stress you place yourself in is low and that you're never in a position where you have to make money trading. I wish you the best of luck in all of your trading efforts. The key to success is to be resilient and never give up. Reduce the stress on yourself and you'll be fine. Here's wishing you all the success in your options trading journey.